If you run a construction business and you've ever tried to get funding, you'll know the process often feels stacked against you. You might be turning over good money, have work booked in, and still be told no or be offered terms that make no sense. In this video, I'm going to explain how business loans for construction contractors actually work in the UK, what lenders really look at, and what tends to work in practice. This isn't theory, it's about how lenders assess risk in the construction sector and why many applications fail before they even get a fair look. Quick note before we start, this is general information, not financial advice. Business lending decisions depend on individual circumstances, trading history, and lender criteria at the time. The first thing to understand is that construction is treated as higher risk by many lenders. That doesn't mean funding isn't available, it means lenders are more selective. They look closely at cash flow, contract stability, and how predictable your income really is. One of the biggest mistakes contractors make is focusing only on turnover. High turnover doesn't automatically mean strong borrowing power. Lenders care far more about net profit, consistency, and cash flow timing. Construction businesses often have uneven income, delayed payments, and large outgoings for materials and labour, and lenders factor all of that in. Another key factor is time trading. Many mainstream lenders want to see at least 12 months of trading, and often 2 full years. Newer businesses aren't excluded, but options are more limited and rates can be higher. Trying to apply too early is a common reason for rejection. Bank statements play a huge role. Lenders review how money moves through the business account. They're looking for regular income, sensible expense management, and stability. Large cash withdrawals, unexplained transfers, or constant overdraft use can raise concerns even if the business is profitable on paper. Then there's the issue of credit. Both business credit and personal credit matter, especially for sole traders and small limited companies. Missed payments, arrears, or high personal commitments can affect approval. Even when borrowing in the business name, lenders often rely on personal guarantees, so your personal financial profile still matters. A big misunderstanding is around what type of funding is suitable. Many contractors apply for the wrong product. A standard unsecured business loan might not be the best fit if cash flow is lumpy. In some cases, options like asset finance, invoice finance, or short-term facilities can align better with how construction businesses actually operate. Another mistake is applying directly to one lender and taking a decline as the final answer. Different lenders have very different appetites for construction. Some are comfortable with contractors and trades, others avoid the sector entirely. A decline often says more about the lender than the business. So what actually works? First, clean and consistent bank statements. Second, up-to-date accounts or management figures that reflect reality. Third, a clear explanation of how the business operates, where income comes from, how contracts are structured, and how costs are managed. And finally, applying to lenders that understand construction, rather than generic lenders with rigid models. Funding for construction businesses isn't about chasing the biggest loan or the lowest rate. It's about matching the right type of finance to the way your business actually works. If you found this useful, subscribe for more straight talk videos covering business finance, construction funding, and common mistakes business owners make. And if you want to explore funding options for your own situation, you can find more information via the links on the channel. Thanks for watching.